I'll kick things off then. Thanks everybody for joining us today. It's our final webinar of 2021, and we wanted to really mark the passing of a year that's been quite interesting for Skarn. Very positive, very busy, and we wanted to take the opportunity to thank everybody that supported us over the course of the last 12 months as well. So we're going to discuss some of the highlights of the year for the mining sector with regard to decarbonisation. We'll run through a few specific issues. We'll be talking about our new water product. We'll talk about carbon emissions a bit. But firstly, I'd just like to say a big thank you to everybody out there who's helped us make 2021 such a landmark year. As most of you probably know, 2020 was really 2020 was a foundation year for us, and 2021 has been all about building on that. And it's been a year of very rapid continued growth for us, building on that foundation we laid last year. Our clients have provided us with tremendous support for the work that we're doing. And there's a whole bunch of other people out there in our network who've also been really, really helpful to us and very supportive. So we thank you all and wish you all the best for 2022. It's obviously been another crazy year for the world. We've also had COP26, so we'll talk about some of that as we get into the webinar. A lot of that feedback that we get from clients and from people we know, people we talk to, feeds directly into the research we do. And that's one of the things that we have made a kind of core value of our business, is to take as much feedback as we possibly can and then figure out how that needs to fit in with the products that we develop. The way we've kind of viewed the journey we're on as a business is very much that it's a journey, and it's part of the journey that our sector is on in adopting and kind of contextualizing ESG impacts. And what we're all about, obviously, is integrating, interpreting hard asset level ESG metrics and tying those together with the economics of the sector. And we're still at the very early stages of that journey. It's early stages for us as a business, but we also feel that it's, you know, early stages for the industry as a whole in figuring out how we integrate all of this ESG stuff. And obviously decarbonisation is probably the GHG emissions are probably the big headline issue right now. But we're all on that same journey together, and it's all been a very interactive one. So we're looking forward to more of that next year. Just to give you all a reminder of what we've done this year, over the course of the year, we've launched several new greenhouse gas intensity curve products: cobalt, lead, zinc mines, zinc smelters, copper smelters and refineries, and silver, on top of the existing curves that we produce, covering aluminium, gold, metallurgical coal, nickel, copper mines, to name but a few. We'll be adding a couple more commodities during the course of 2022, and we'll communicate more about that as our plans firm up earlier in the year. And the other big launch, of course, which is why we have Raymond here on the call, is the Skarn Water Gold Mines product. We launched that a couple of weeks ago. The copper mines version of that is due for launch in the new year, and we're very excited about that as well. So we're going to be communicating lots more new product development as we go. And, you know, obviously, hopefully everyone kind of gets the message that we're on a very energetic growth path right now. Paul, are you back with us as a panelist?
In voice, yes.
If voice is good enough,
That's perhaps the best bit. So yeah, count your blessings.
Anyway, I hopefully made a reasonable job of covering for you on that. Paul, would you like to take over and talk a little bit about COP26 and how that fits into everything, and lead us into a bit more of a panel discussion?
Absolutely, and apologies for everybody for the mishaps today. In addition to me hosting the event, obviously Mark here, co-founder and CEO of Skarn, who is today included in the Mining Journal 2021 Most Influential list at position number 43. We also have other Skarn co-founder and lead consultant Charles Cooper and Skarn's ward consultant Raymond Philippe with us today. We're going to start, as Mark said, we're going to start talking about one of perhaps the standout things of this year, and that was the COP26 summit in Glasgow in the UK in November. Some highlights from this included more than 90 nations, including the USA and China, committed to reduce methane emissions by at least 30% from 2020 levels by the end of the decade. Coal continues to be a bone of contention, with many countries agreeing to decelerate the phase out of coal power and inefficient use of coal subsidies for fossil fuels, with more than 40 countries agreeing to phase out coal-fired power, including Canada, South Korea, Ukraine, Indonesia, Vietnam, and Poland. China and India remain significant stumbling blocks there, given the size of their economies and the fact that their power grids are coal dependent. India specifically watered down language to phase down rather than phase out in the final COP26 agreement. COP26 also succeeded in setting rules for carbon markets, which could be used to unlock funds for protecting forests, building renewable energy facilities and other projects to combat climate change. Mining obviously has a key role to play in addressing climate change, both in reducing its own emissions, which is obviously a key focus of Skarn and Skarn products, as well as providing the key materials such as copper and nickel, the products and technologies and solutions to help overcome the climate challenge require. Skarn produces carbon curves at an asset level for a host of metals, and is leading the charge in terms of providing better quality information for decision makers. So let's look at some of the what we think are the sort of key standout developments or advances of this year. One of them, Charles, let's start with you. Sustainability reporting and net zero targets. You noted that many small to intermediate mining companies now, not just the large miners, are publishing sustainability reports and setting their aspirations to get carbon neutral. So let's start with you. Why is this important for the sector? And what is your view in terms of the quality of the information companies are reporting?
Thank you, Paul. Basically, I think the main deal for the industry is driven largely by investor pressure and a big sort of step change within social habits in terms of trying to effectively reach that goal of decarbonizing the industry by 2050. And what we've sort of seen is a sort of significant increase in reporting by not just the majors, but the mid-tier and the junior mining companies right across the various different commodity spaces, and providing a lot more information on their emissions, energy consumption, and all of the other aspects surrounding the ESG space. And this is a significant change from 2019, let alone 2020, where even the mid-tier sector were not reporting very much information on their ESG and sustainability credentials. The quality of the data being reported appears to be improving. We have noted that there is more granular information available. That makes our job a lot easier when we're trying to look at the industry on a mine and a smelter asset level basis. But it is still open to a degree of effectively open to a significant degree of obfuscation in certain areas. So some, we're finding sort of errors in data, we're finding errors in methodology, and areas where companies could benefit from an improvement in standards that they should be following. That said, when you're looking at things like CO2 emissions, there's obviously the GHG protocol, and the IPCC sort of standards that we sort of would recommend companies sort of follow. On water, Raymond will comment on that a bit later, but there are a number of standards there. But again, when you start to look at the asset level information, we're seeing a significant difference between commodities, ranging from CO2 intensity and energy intensity, which is not unsurprising given the location of some commodities and some mining assets, but also an area within the industry where we're sort of seeing a significant step change. There are a lot of companies targeting significant reductions in carbon intensity by the end of this decade. There we go.
Okay, thank you, Charles. And I think that also taps into a sort of broader desire for standardization amongst regulators. I mean, the SEC in the US, for example, has been very vocal in its demands that there be greater standardization of information and definitions related to sort of ESG aspects for investors to and issuers to have to comply with. There are a plethora of standards out there, and I guess we're still in relatively early days, and these things will gradually sort of narrow down and hone down to a more widely used and accepted set of standards and reporting. Let's broaden this out, actually. Mark, you mentioned that company E1 competitive positions and SBTI as one of the standouts there. Now, let's start off with SBTI. Yamana Gold, for example, just published its first decarbonisation goals using Science-Based Targets Initiative, which is the SBTI, which brings in obviously one of the contentious issues around decarbonisation plans. So, Mark, what is SBTI? Why is it important? And why aren't all miners using it?
So the Science-Based Target Initiative is the very widely accepted now as the gold standard for greenhouse gas reduction target setting. And it's a very well structured, very well thought out set of protocols that companies are encouraged to use in setting targets. And what we've seen up till now, and there's still an awful lot of this in the mining sector, is that the targets which are being set are, shall we say, somewhat hazy and stated in quite inconsistent terms from one company to the next. So there's a whole mixture there of absolute emissions targets, which are relatively clear. I mean, it's quite straightforward to state that you're going to reduce your overall level of carbon emissions by X billion tons. That's easy to understand. But there's also a whole bunch of people out there issuing rather poorly defined intensity-based targets. So those could be on the basis of carbon emissions per ton of rock processed, or per ton of, or per pound of copper produced, or whatever they are. SBTI cuts through all of that, and the whole point behind SBTI is it's also tied very closely to climate change targets. So the SBTI protocol was revised back in July this year quite radically to fall in line with a 1.5 degrees C temperature rise scenario. And in real terms, that means that most miners are going to have to make 42% reduction in their emissions relative to a recent base year by 2030. So that's going to be pretty ambitious. That relates solely to scope 1 and 2. It doesn't include any scope 3. But given the headwinds that we know miners face at their mining operations in terms of falling grades, increasing strip ratios, increasing ore hardness, increasing refractory gold ores, things like that, this is going to be quite difficult to achieve. But on the positive side, we are seeing a few other things happening. So I'm going to very quickly share my slide of the year, which is and hopefully you can see that now. But looking at the major companies across the full range of commodities, What I've done here is and I've not ranked it. I've ranked it alphabetically. I haven't ranked it in any kind of good to bad type order. But the multicolored blobs here represent each company's position on the E1 greenhouse gas intensity curve for each commodity. So,
Mark, let me just jump in there. Can you explain what the E1 is? I mean, a lot of people might not be fully cognizant of that.
So E1 is Skarn's proprietary metric for greenhouse gas intensity, and it's scope 1 and scope 2 mine site emissions, plus the downstream emissions, so some elements of scope 3 relating to transport of intermediate products from the mine to the smelter and refinery, plus the smelting and refining emissions. So it takes you from rock in the ground right the way through to refined metal sat ready to go into the market at the refinery gate. So it's an attempt by us to create a metric that is appropriate for mining sector supply chains, at least as far as, you know, refined metal. So what this chart's telling you, for instance, is that Anglo American's carbon emissions from copper on an aggregate basis across all of its assets, put it around the 30th percentile of carbon emissions on that E1 basis, so relatively good. Whereas at the other end, you have its iron ore emissions, which are the brown blob, which are around the 80th percentile, which is obviously less good. Going through all the companies there, you can see how they all plot up, and you can see there's obviously a pretty wide range of carbon intensities from company to company. And what I've also done there is I've also identified those companies which have signed up, which are ICMM members. And the key thing there is that in October this year, the ICMM membership all committed to hitting net zero carbon emissions by 2050. And I guess the point there is you can see that many of them, and obviously this is looking at emissions intensity in relative terms, in competitive terms between companies rather than absolute emissions volumes. But what you can see there is some companies have got some pretty hard work to do to get themselves down the respective carbon intensity curves for the commodities they produce. I guess if you look at some of the targets which we've attempted to summarize there, the point number one is that those targets are all stated in very diverse terms. And that was the main point I wanted to make about the targets, is that targets themselves are stated in a whole plethora of ways. And I think knowing that these things have been unified under the Science Based Targets initiative is actually going to impose a whole load more consistency on the way targets are stated. Because right now, it's really quite difficult to figure out whether somebody's target is ambitious or not in the first instance. 6 of the companies here have published no targets yet, which in itself is a pretty interesting insight. I think what we're going to see is these targets are going to be refined. They're going to have to be followed up with tangible action plans for delivering on them. And that's going to be one of the next big things, because right now, nobody's really sure how anybody's going to hit all this. Everybody's got some pretty good ideas about some of the technologies that are going to be used and some of the levers that are available to pull. And we're going to talk about those following on from this. But that's going to be the next phase. So anyway, I'll stop sharing that now, and Paul, you can.
Thanks, Mark. I think one of my observations there is that a lot of these targets are initial targets, companies that are making with perhaps imperfect information. We have seen earlier this year, a couple of miners made their targets even tougher because they'd achieved ahead of what they thought. They'd achieved their goals ahead of the time they thought it would take, and so they've toughened them up, tightened them up, and I expect that is going to continue. You mentioned ICMM a couple of times there, Mark, so let's go into that in a bit more detail. ICMM, the International Council on Metal Mining, represents 28 of the largest miners in the world, and it's really stepped up this year by establishing various standards and requirements for its members. At face value, that seems very positive and responsible action, but I guess it opens a bigger question: is can and should the sector self-regulate on this? Mark, Charles, who'd like to take that?
I'll start off if you like, but I think we have, whether the sector likes it or not, there is already a tremendous amount of, if you like, external interest. And that external interest is backed up by cold, hard investor cash. So I think almost in a way, the ICMM has taken a very proactive step in response to that reality. And so I think the issue of self-regulation, I wouldn't phrase it that way. I'd think of it more in terms of a whole breadth of different pressures, interests, standards that have impacted the sector and in kind of aggregate create a pretty powerful motivating force for companies to get real about decarbonisation. I think that's what we're seeing happen. But I'll ask, Charles may have something to add on that.
Yeah, thank you, Mark. I think what's interesting is that, you know, we're sort of seeing a whole plethora of standards that are being announced literally almost on a sort of a monthly basis. And the ICM sort of standard is incredibly welcome in our view, that it creates a sort of a logical framework to hang the industry's hat on effectively. But there are a number of other areas where the industry can be self-governing, self-regulating, and we can look at it from a different perspective. I'm just going to share a slide just looking at how the copper miners or individual copper mines fare with regards to emission intensity and those that have signed up to the copper mark, effectively guaranteeing a traceable supply of metal based on ESG credentials within a supply chain. So in other words, these mines that are showing on this chart here, where we're showing emission intensity, where on the right-hand side, the highest, the mines with the highest CO2 intensity, where obviously per ton of copper equivalent. And the vertical bars in orange sort of show you the current participants of the copper mark. What it appears is that they're fairly, sort of widely distributed across this carbon curve. And it also suggests to us that the average emissions from those who are participants of the copper mark are currently not as competitive as some of the other participants in terms of carbon intensity. So currently, on average, for the copper mark participants, which account for about 23% of global supply, we estimate the average emission intensity to E1 is about 4.94 tons of CO2 per ton of copper equivalent, compared to the industry average of about 4.67. However, we expect this to decrease over the next few years as many of the mining industry, participants in the mining industry switch over to renewable power sources, particularly from purchased electricity. That will probably remove something in the order of about sort of 20 to 30% easily of emissions relating to scope 2. Now, the industry also categorizes emissions in terms of scope 1 and scope 2, which are typically at the asset in question. Scope 2 refers to purchased electricity or heat or steam from third-party sources, and the emissions related to every megawatt hour being purchased. And that's typically expressed as a grid factor. And then scope 1 emissions tend to be from diesel consumption in haul trucks or on-site power generation, as well as natural gas and a few other sort of key elements. When we sort of start looking at what could happen in the industry, we're sort of seeing, certainly from the copper perspective, that when you start to look at what the challenges that the copper mine supply faces, the majority of the emissions in the supply chain to produce NME copper are found at the mining stage, upstream emissions. So typically 62% of emissions for producing copper are found in mining, or at the mining stage. 6% relates to transport and freighting of concentrate from mine to smelter. And then about 27% is from smelting and another 5% from refining. Effectively, most of those emissions are from the mining stage. And the majority of that is from purchased electricity. So when we start to look at the opportunities to decarbonize the mining industry, we're going to start with effectively mining companies and mining operations looking to purchase more renewable energy. And that would hopefully reduce the emissions that are being currently produced. And then the next challenge will be to decarbonize the haul fleets, effectively removing diesel as one of the main components of CO2 emissions there. So basically, this is a very busy slide, but it gives you an impression as to where the challenges are in the industry in terms of decarbonisation. So this is just sort of showing you all basically the stacked emissions from the different sort of stages within the supply chain. And then sort of finally, if you start looking at across the rest of the sector, you can sort of see looking at things like power purchase agreements and moving to more renewables contracts, certain commodities would benefit more than other commodities. So, for example, platinum, zinc, lead, silver, gold, and iron ore. These commodities, I've missed off copper, these commodities have a bigger exposure to purchased electricity than, say, crude steel or alumina. And so we can see, more emissions being taken out of the supply chain for some of these commodities than for some of the others, just from switching over to power purchase agreements and renewable energy.
Thank you, Charles. We're going to talk more about power purchase agreements in a moment, but just a couple of reflections there. The copper mark is based on sort of a broader, a fuller ESG assessment, and not just on the carbon footprint of the operation. So, it's dangerous to use the copper mark as a proxy for low carbon copper, it seems, coming out of that. One of the things related to your slide about the diesel element of carbon emissions in mining, this year has been noticeable. The number of big copper miners, not just the big diversified miners, they pretty much all entered into some kind of strategic alliance or joint venture with OEM providers, pretty much focusing on, how do we get diesel out of our mining fleets, whether that's Caterpillar, Komatsu, Liebherr, whoever. Seems to be a lot of work, a lot of research going on to crack this particular nut. Okay, let's dig a little bit deeper into PPAs, renewable purchase power agreements. We've seen a big push by miners this year, particularly copper miners in Chile, towards putting in place renewable energy agreements via PPAs, which are long-term agreements that provide a power utility with the confidence to invest in the development of renewable energy sources backed by a long-term contract with a mine. However, while they look like a duck, and certainly quack like a duck, the reality is that having these renewable energy agreements doesn't always mean a mine has green energy. The reality is they still get power from a hydrocarbon-fired grid, given the limitations of solar supply throughout a 24-hour period, for example. Skarn did some research on this earlier in the year, and we saw it as quite a thorny issue about how the benefits of renewables can be apportioned to mines connected to a grid. There's a lot of aspects that still need to be resolved and worked through. So what are the kinds of things that people need to be aware of, Charles?
I think the biggest concern we have is that when it comes to the number of new contracts that are being sort of announced, is effectively, there's a certain degree of investor there's a number of investors that we've spoken to who are concerned about the reliability of the energy sources actually being renewable energy, and that the mine is actually genuinely purchasing electricity from pure renewable sources as declared by their power purchase agreements. Generally, in most cases and in most developed nations, you'll find that that is a trail that is audited, not only by accountants, but a number of different market participants within the industry. So there is a degree of hopefully guarantee that what companies declare in terms of purchasing effectively renewable energy in the future is coming at is genuinely being sort of delivered. Mark, have you got any other sort of thoughts on that?
I think I think my initial skepticism about PPAs is actually moderating over time. I think there's probably going to be instances where they are called into question, possibly quite rightly in some cases. But I think there's so much focus on this now, and the power utilities themselves in most jurisdictions will be under some degree of scrutiny to ensure that they're not double selling renewable power. I'm actually more sanguine about the whole thing than I was at the beginning of 2021, when obviously everybody in the sector was scrambling for PPAs. I think PPAs are going to be a massive driver of Scope 2 reduction, obviously, and in some ways it's the easiest lever for mines to pull in decarbonising. So I think they're going to continue to be a really important component of decarbonisation, and ultimately we're going to have to get comfortable with them.
I think just going back to this slide here, the red line here just gives you an indication as to effectively the grid factor. So that is the tons of CO2 being purchased by each of the different commodity groups I've put on the chart here. So for example, in platinum, for every sort of for every megawatt hour being purchased by the platinum sector, more or less 1 ton of CO2 is coming with that purchased electricity. And on the low end of the spectrum, where you've got cobalt, much of it coming from the DRC and in a lot of its hydroelectric power, we're seeing things like sort of electricity supply, relatively low at 0.2, and actually it'll be a bit lower than that if you looked at purely just the DRC. So you've got a big change between those different commodities, those different mines within each of these, producing each of these different commodities, where we can see the opportunities for power purchase agreements really making an improvement. From a context, it's difficult to see how that would really work with platinum just at this stage, particularly with the dominant supply of Eskom. But in terms of zinc, copper, we see some significant opportunities in Scope 2 reductions by just shifting over from natural gas, diesel, coal-fired power generation to hydroelectric power and solar energy. And without that, it's going to be very difficult for the mining industry to effectively electrify its ore fleet, because it's no point electrifying it if it's all coming from coal or diesel or fossil fuel power sources.
Thank you, Charles. Okay, let's move on to water now and bring in Raymond Philippe into the conversation. We talked a bit about ICMM. ICMM also issued the second iteration of their water reporting guidelines this year, which also align with the Global Reporting Initiative guidelines. Raymond, let's start there. Why was this a big deal, and why is measuring the water performance of mines different to measuring the carbon emissions of mines?
Okay, thanks for that. First of all, I think the big deal about this one is that it is the second version. The first version for the ICMM guidelines came out in 2017. This is 2021 version 2. It builds up on what they already defined in 2017, but they also decided on increasing the amount of required parameters to report on, and that goes even beyond what is the requirement set forward by GRI in their 2018 guidelines, as the mining sector being different, I would say, from most other producing sectors, as their water footprint, or the area where they interact with water, typically is bigger. So they also require now for every mining company at asset level not only to report on withdrawals and the source of withdrawal and on the discharges and on the consumption, but also on the water reuse. And that is an efficiency factor that can be brought in. That is different from what GRI is asking for. In that sense, from a guideline setting, they're trying to be best in class compared to other sectors. That's a good thing. The challenge there is still then to understand, and that's also what we have been finding with the development of the first product that we did now with Skarn on water, is to validate the data that are being reported. How valid is that data? Are they using the correct definitions? Are the data, do they make any sense? Some of the data are still incomplete in the way that it's reported, or it's still reported at aggregate level, at country level, for example, or at company level. So in that sense, there's still a lot to be done. Also on the auditing part, ICMM also implemented in last year in 2020 a validation process where they require a third-party validation of the numbers they present in their reporting. And that it's going to be a challenge also how to give or how to provide numbers to an external party to validate the background of those numbers. How representative are they of the reality? And I think that's that transparency, and that might be a conflict of confidence for the external world. To me, ICMM is it's a front runner within the mining space, and to be connecting to the rest of the economical world. Let me put it that way. And they have a very big pull effect on non-ICMM members as well to give them a guidance also on their reporting standards, but they're still seen from the outside as a sector group, so they're not an independent group. So I think there is still a lot to be worked upon on how the external stakeholders get a good feeling of what's happening internally in the mining industry. That's one thing. The other, what's the difference then there between water and CO2? I think water is a couple of years behind in the development on reporting and on analysis and on evaluation on ESG compared to CO2. And from my perspective, that is mostly related to two specific issues. One is the complexity of water, as there are a lot of parameters to be evaluated to define whether a parameter is good or bad for a certain operation. For example, it's different water consumption in the desert region than it would be in a very humid region. And the other one is it's the very contextual local analysis that you would have to do to understand how what's the impact of water on the surrounding. And a third part there is also, compared to CO2, water is not only has an effect on the surrounding, it has also, water is a revenue or a risk factor for the production itself. CO2 it's the outcome of your production process, whereas for water it's both. It's the outcome in the sense what's the impact to the third-party stakeholders, but also if there is a lack of water or if there is an excess of water, that also means that there is a risk of not being able to produce what you want to produce, and that's that combination makes water a bit more complicated than CO2 from my perspective.
Thank you, Raymond. Let's dig into that a little bit more deeply, if we may. And water metrics example. One of the challenges I see with water is there's perhaps an absence of clear or meaningful metrics to measure what is happening, and then actually getting companies to report against them in sort of good faith. And I imagine this was one of the fundamental reasons why Skarn launched its gold water product recently and will soon launch its copper water product. Just as one sort of very obvious example, perhaps the water metric most people are familiar with is recycling rate, but that is often calculated incorrectly. Can you just talk a little bit about what the sort of gold water product and what the copper water product, what are they measuring and what will they help people to do?
In the case of reuse or recycling, it's an efficiency measure. So how good is a specific mine reusing or making use of all its water? So if they're doing a very good job at it, it means that they are impacting less water from the outside world. The problem is it's not. As it is a very specific mining metric, and there is a definition of it by ICMM, and that's not the same definition as being reported by all of the mining companies. Whereas the ICMM definition indicates the reuse efficiency as the amount of water that is being captured at the downstream of your process, and that's being integrated again in the process. And so it's an indication of what your make-up water requirement is. Some companies report as the reuse efficiency as the amount of water that's being reused divided by the makeup. That gives a completely different outcome, and you see very high efficiency numbers of operations that in fact are not doing that.
Okay, thank you. So talking about the Skarn, the gold water product and the copper water product, what can users expect to be able to do with these products?
First of all, what you can do from a physical water perspective and from an ESG perspective, it is possible to benchmark and to identify what a certain company or a certain asset can do or is doing and has reported to do related to withdrawals. For example, how much water has been withdrawn to produce or to process a ton of ore, or to produce an ounce of gold, or that's one metric. On the other side, you have on the discharge side, how much water is being discharged per ton of ore processed, or per ton of ore, per ounce of gold produced. So those are very physical impacts. But basically, what we also are doing is by using georeferenced local climate data, we can overlay that and we can indicate what are the impact trends from a climate perspective on the production at risk, for example, because of drought or because of flooding. Some of the mines are in a situation where we know in regions that have seen for the last couple of years a big decrease of water availability and have already started reporting production losses because of that. So what is the trend for a mine in at a certain site to have that kind of risk? So we take it from not only physical parameters or physical evaluation and comparison to also to risk comparison at production level, and also the economical impacts of that per unit of production. And we have that now for gold, covering quite a lot of the global gold production, and we're currently working on the copper product.
Thank you, Raymond. As a sort of final talking point, I'd like to sort of unify the two elements, water and carbon dioxide, the water energy nexus. For example, seawater desalination for copper is increasingly required in many parts of the world, particularly in South America, but it adds a massive energy component to a project, both the desalination process itself, but also the distribution network to pump water dozens of miles up to high elevations, resulting in obviously high added capex and added opex, as well as adding to the carbon footprint. So is there an element of sort of robbing Peter to pay Paul here in terms of the overall sort of ESG footprint? Who'd like to tackle that? Mark, Charles?
That's an interesting question there, Paul. And I think you can look at different sort of commodities, and I think actually the focus here is largely on copper, where the majority of copper being supplied or produced in the world is coming from the Latin American continent, particularly Chile and Peru, where there has been there's been often a standoff between water availability in certain areas, particularly Atacama Desert, where there is a significant lack of water, and many of the new mining operations are obliged to source that water from saline sources, literally pumping water many hundreds of kilometers up from sea level up to sort of 3,000-4,000 meters above sea level. So all of that has a material a potential cost, not just in terms of capex. So we could be dealing with several $100 million of additional capex for any particular copper mining operation. But they also increase the underlying cost base, from literal pumping costs of that water and desalination. And again, that is often relatively energy intensive, and that then has an impact upon energy supply and consumption within the region. And that also puts more stress on an area where mining companies, industries are trying to decarbonize. So we're sort of seeing that in order to effectively decarbonize, improve, and become good practitioners in terms of water consumption and efficiency, that is translating into a material cost. Raymond, how do you sort of see that?
Now, to me, it's not only for the water supply for the mining industry itself, for the mining operations, and that I've been involved in projects where you would have quite a significant amount of energy supply required for the mining operation and for the water supply to that mining operation. But it goes also the other way around, and in a sense, with new, for example, green hydrogen coming up, and especially in you will see that at dry places mostly, because of very often it's associated to photovoltaic or solar projects. Hydrogen by itself, it also requires water, and mostly desalinated water very often, to get produced. It's about 9 cubic meters of water that you need for a ton of hydrogen. And where do you get that water from then? So it goes both ways there. So you need to produce copper, for example, you need water. To get water, you need energy, and for that energy, you need water again. It's going to be interesting how deep you want to dive into that analysis. It is possible.
Excellent. Well, thank you, Raymond. I think we're running to the end of our time today. So to draw some conclusions, we're still in the beginning of the journey that we mentioned at the start of this webinar. With regard to decarbonisation, especially water, the industry and its stakeholders are realising that ill-defined woolly metrics and tip box reporting exercises only get you so far. We are seeing a sort of growing acceptance that analysis based on technically sound asset level data is the way forward. And on that note, we wish you all the best for the festive season and a happy and prosperous 2022. Thank you, everybody.